The gold-silver ratio is a fascinating subject with deep historical roots. It represents the amount of silver required to purchase a single ounce of gold. This ratio has fluctuated throughout the ages, reflecting economic conditions, monetary policies, and even societal values. Understanding this ratio provides valuable insights into the dynamics of precious metals markets. It also sheds light on broader economic trends. The ratio is influenced by a complex interplay of supply and demand forces. These forces affect both gold and silver independently. Historically, gold has been viewed as the ultimate safe haven asset. Silver, while also precious, has more industrial applications, impacting its price volatility. By analyzing the gold-silver ratio, investors can potentially identify periods where one metal might be overvalued or undervalued relative to the other. The gold-silver ratio has seen incredible variation throughout history. In ancient civilizations like Greece and Rome, the ratio hovered around 10:1 to 12:1. This relatively stable ratio reflects the use of both metals in their monetary systems. During the Roman Empire, the ratio was fixed at 12:1 by law, highlighting the significance of these metals in their economy. This period of relative stability underscores the enduring value placed on both gold and silver. However, the ratio has not always remained constant. The 19th century saw a shift towards a 16:1 ratio, largely influenced by the adoption of bimetallism in some countries. This system, which used both gold and silver as backing for currency, aimed to provide greater economic stability. However, the discovery of vast silver deposits in the late 19th century led to a decline in silver's relative value, pushing the ratio higher. The gold-silver ratio is a testament to the evolving relationship between these two precious metals. In the 20th century, the gold-silver ratio experienced further volatility. The abandonment of the gold standard after World War I resulted in a decline in the ratio, dipping below 20:1, as gold's role as a primary monetary anchor diminished. However, the latter part of the century witnessed a surge in the ratio, reaching a peak of 98:1 in 1991. This period of instability was influenced by factors such as the oil crisis of the 1970s and the subsequent inflation. Today, the gold-silver ratio remains a closely watched indicator for investors in precious metals. It provides insights into market sentiment, economic uncertainty, and potential investment opportunities. By understanding the historical context and the factors that influence the ratio, investors can make more informed decisions. Numerous factors can influence the gold-silver ratio, making it a complex and dynamic metric. And one of the most significant factors is the interplay of supply and demand for each metal. Discoveries of new gold or silver deposits can impact their respective prices, thus affecting the ratio. Similarly, changes in industrial demand, particularly for silver, which is widely used in electronics and solar panels, can influence its price relative to gold. Beyond supply and demand, macroeconomic factors also play a crucial role. Global economic uncertainty, geopolitical events, and inflationary pressures can all impact investor sentiment towards safe haven assets like gold and silver. For instance, during periods of high inflation, investors often flock to gold as a hedge, potentially driving up the gold-silver ratio. Understanding these multifaceted influences is essential for interpreting the ratio's movements. The availability of gold and silver, both above ground and underground, is a key determinant of their prices and, consequently, the gold-silver ratio. It is estimated that approximately 200,000 tons of gold exist above ground, primarily in the form of bullion, jewelry, and official reserves. In contrast, silver's above-ground supply is estimated to be around 500,000 tons, reflecting its more extensive industrial applications. Estimating underground reserves is more challenging as it involves geological surveys and exploration efforts. Current estimates suggest that around 50,000 tons of gold and 500,000 tons of silver remain undiscovered. These figures highlight the finite nature of these resources and the importance of sustainable mining practices. Gold and silver exhibit distinct consumption patterns influenced by their unique properties and applications. Gold's primary uses lie in investment, jewelry, and to a lesser extent, technology. Its resistance to corrosion and its aesthetic appeal have made it a prized possession for centuries. Silver, on the other hand, finds extensive use in industrial applications including electronics, solar panels, and medical equipment. The investment demand for both metals is a significant driver of their prices. Gold is often seen as a safe haven asset during times of economic uncertainty, while silver tends to be more sensitive to industrial cycles. Understanding these consumption patterns is crucial for interpreting the dynamics of the gold-silver ratio.